Hello viewers, today's topic is capital structure. Capital structure is a process of structuring the capital required by an organization. What is structuring of capital required? The structuring is a combination of various sources of funds like the whole capital can be raised through equity or the capital can be raised with a combination of equity and debt. In third case, the total capital required can be raised through equity, debt and preference share capital in a proportion deemed fit by an organization. Let's understand a company named S Limited wants to raise 200 lakhs. There are three capital structures available. In first one, the total capital can be raised through equity share capital. In second case, the funds required are raised through equity and debt, 100 lakhs each. In the third combination, the whole capital can be raised through, from equity we can raise 100 lakhs, from preference share capital we can raise 50 lakhs and from debt we can raise 50 lakhs. There can be a question in your mind, why we raise funds through various sources? What are the advantages of raising funds through different sources? Let us discuss with an example. Let us understand an important calculation after raising new capital. As we know, we are raising the new capital through three capital structures as we have mentioned earlier. So we'll calculate by starting with new EBIT. What is new EBIT? First of all, we'll have some existing capital employed. On that capital employed, we'll have some earnings. So using these two tools, we'll understand percentage of return on capital employed. With this percentage, we'll apply to existing share capital plus new capital. On that, we'll apply the percentage of return of capital employed. We'll get new EBIT. Coming to new total interest, if the existing capital consists of debt funds, then the interest is written in all the three capital structures, plus new interest is written only in the capital structure where we have introduced debt funds in the new capital structure. After that, we'll get EBT less tax, we'll get EAT less preference dividend. Preference dividend, in case if the existing capital is having preference capital, then the preference dividend is written in all the three capital structures. But new preference dividend is only written in the capital structure where the preference share capital is there. After deducting preference dividend, we'll have earnings available for equity shareholders divided by number of equity shares. Same with the number of equity shares, existing number of shares plus new shares. New shares are arrived through new equity capital raised. So by this we'll get EPS, earnings per share. The objective of financial management is to maximize the wealth of shareholders. By analyzing different capital structures, we shall determine where the EPS is high and choose the capital structure beneficial to the shareholders. And after getting EPS, we'll multiply with PE ratio in order to get market price per share. As we know EPS, we shall know MPS, market price per share, and how it is arrived at. The market price is arrived by the supply and demand dynamics of the market are responsible for changes in the market price of a stock. Basically, market price is high when the demand exceeds supply and market price is low when supply exceeds demand. In the stock market, the market price is determined by price discovery mechanism. Let's understand what is price discovery mechanism. Let's understand with an illustration. There is a case where supply is of 10 paintings and for these 10 paintings there were 100 buyers. So obviously each bidder is going to bid a higher price than the previous bidder. Eventually the market price will rise. In the same way, when the supply was 100 paintings and the demand was only 10 buyers for the paintings offered. In this case, as most buyers are not interested, the market price will be low as compared to the above situation. In the same way, if a company is there having 5 shareholders holding 1 share of rupees 100 per each share, after a bad news about the company, 4 shareholders want to sell their shares and there was only one buyer who was offering or bidding the share at rupees 100 per share. 2 buyers sold at the rupees 100 per share. Another buyer bid at 90 per share. As the shareholders were in uncertainty, they sold the shares at 90 per share. Eventually, the market price, which was 100 per share, was now fallen to 90 per share. This is the way how the market or the how stock market operates. Capital structure which have the highest EPS, where we have P ratio given in the question. We have to multiply EPS with P ratio and arrive at MPS, and on that MPS basis we shall select the capital structure which have the highest MPS to align with the objective of financial management to maximize the wealth of shareholders. Let us understand what is the use of calculating indifference point. Before going to the use of calculating indifference point, let us understand what is an indifference point. As we know, EBIT is same for any of the capital structure, and indifference EBIT is arrived by equating the EPS1 is equals to EPS2. When we are equating EPS1 is equal to EPS2, as both the EBITs are same, we'll get a common or indifference EBIT where both the EPS are same. Okay, as we have understood what is an indifference EBIT, let us understand the practical use of indifference EBIT. For example, NS Limited is in a software business. It has calculated its indifference EBIT is of rupees 50 lakhs. So it have conducted a market survey, and the results of market survey fetch that the maximum amount of EBIT that a company can earn in the current market situation is of rupees 50 lakhs. So now it is very easy for the NS Limited to determine the capital structure at which the company can raise the funds with a convenience, because the indifference EBIT is equal to the result we have fetched from the market conditions. So it is at the discretion of the company to choose which capital structure to be selected with ease and with less documentation to get the funds more quickly. As per the net income approach, let us take a firm is raising the debt and decreasing the proportion of equity due to the reason where the cost of debt is low and the cost of equity is high. So eventually the overall cost of capital is low as the major funds are acquired at a lower cost, which is the debt funds are acquired at lower cost. So as we know, the overall cost of capital is inversely proportional to the market value of the firm. In this case, the major funds are acquired at a lower cost. In return, the cost of overall capital will be low. So hence the market value of the firm will be high in net income approach. The next topic is traditional approach. It is somewhat reasonable compared to the above approach. In this, the overall funds raised by the company as the debt increases. What are the factors which are affecting due to increase in the debt? Let's understand. As the debt increases, the cost of debt increases as banks feel more risk to provide additional debt funds. Due to the increase in the risk, the cost of debt also increases. And also the equity are also taking risk. How they are taking risk, let us understand. As the debt increases, at the time of winding up, the payment to equity shareholders is in uncertainty, as the major chunk has to be paid to the debentures first than to the equity. So due to the increase in risk to the equity shareholders, their cost also increases. So resultant of that, the overall cost is also increased. Due to increase in the overall cost of capital, the market value of the firm will be decreased. In Modigliani-Miller approach with tax, it considers the saving of tax by raising debt, and due to this, suggested that tax saving shall also be included in calculating the value of the firm. It is the most practical point we have come across these approaches. For example, in a levered firm, we have interest. Due to that interest, the EBIT will be reduced. On that reduced EBIT, which is known as EBT, the tax amount will be less compared to the EBIT. Whereas in unlevered firm, where there is no debt, the EBIT is equals to EBT, where the tax is on whole EBIT. Here there is no question of saving tax. But in levered firm, the company saves tax. by including interest. The interest is due to increase in the debt. So Mr. Modigliani Miller has suggested that value of levered firm is increased compared to the value of unlevered firm, as value of levered firm is equals to value of unlevered firm plus debt into tax rate, which means value of levered firm is greater than value of unlevered firm to the extent of saving done due to increasing the debt. Let us consider in earning terms. Earnings of levered firm is equal to earnings of unlevered firm plus interest into tax rate. Let us understand arbitrage with an example. Consider M Limited as a levered firm and N Limited as an unlevered firm. So while calculating EBIT, we have same amount of EBIT less interest of only levered firm, that is N Limited will take 7,000, will reduce from 20,000, will get 13,000 for M Limited and 20,000 for N Limited as earnings available to equity shareholders. Given KE is equal to 11.5% for M Limited and 10% for N Limited, okay. We know that value of equity is equal to earnings available to equity shareholders divided by KE. So for M Limited, we got 1,13,043 rupees, and for N Limited we got 2 lakhs. It is the value of equity, and value of debt is only for M Limited because M Limited is a levered firm. So value of debt is equal to 1 lakh. The total value of the firm of M Limited is 2,13,043 rupees, and value of firm of N Limited is equal to 2 lakhs. Let us calculate the return of investment. Return of investment is equal to EBIT divided by value of firm. M Limited ROI is equal to 9.38% and N Limited ROI is equal to 10%. In this case, an investor wants to move from low ROI to high ROI. That means the investor will move from levered firm to unlevered firm. As we want to move from levered firm to unlevered firm, let us sell the equity of 10% we hold of M Limited, that is 10% of 1,13,043 rupees. We'll get 11,304, and we should consider proportionate debt also, that is 10% of 1 lakhs, which is 10,000. Total investable amount we got is 21,304. Against the earnings from N Limited, which is 10% of total earnings of the firm, is 1,300, and invest the same proportion in N Limited, that is 10% of 2 lakhs, which is 20,000, and earnings available to equity shareholders into 10% is equal to 2,000 less the interest on debt which we have took from the levered firm, that is 7% of 10,000, we got 700, and the earnings from N Limited is 1,300. Here the earnings of N Limited and M Limited are same, but the investment has reduced from 21,304 to 20,000. Here the arbitrage arises. Now I want to share with you some of the important aspect of this question. Why we need to take 10% proportionate debt? That is the question in many students. The first aspect is the amount of fund raised is same, but the difference between levered firm and unlevered firm is that in case of levered firm we'll have equity plus debt, and in case of unlevered firm we'll have totally 100% of equity only. So to compare both for the arbitrage purpose, we need to take the proportionate of equity and debt in case of levered firm, and the same proportionate we shall take from unlevered firm to match them and get arbitrage loss or gain. In second aspect, while we are taking the earnings of levered firm, we are considering the risk of interest available in the levered firm. We are treating the debentures as our own fund and considering risk of debentures in the form of interest while calculating the earnings. So we should take proportionate both in equity and debt, and after taking that amount, if we are investing the same amount in the unlevered firm, there also we will be incorporating the risk of interest by reducing from the earnings of unlevered firm and getting the net earnings. The main aim of these two aspects is to compare the investments and to assess whether the arbitrage gain or loss while shifting from levered firm to unlevered firm.